All right, good evening, everyone. We'll be looking today, a cursory look at the order block theory. That's what we'll be looking at. I'll be digging a little bit deeper. I want to state here that I basically learned the order block from Michael of ICT. Yeah, if you have questions, sure, you could ask questions. Right, so I learned this from order block from theory from ICT, and I give credit to him. Of course, he has a lot of wonderful videos and educational materials on YouTube. You could go look at them also. All right, so it's not entirely my idea per se. Let's move on. Right, so what we'll be doing today will be looking again at what an order block is with a slight twist in definition. Now, clearing out some of the gray areas that has been coming up as in form of questions in our Telegram group. We'll be clearing them out, and we'll be introducing the concept of the strong and weak order block that might also help in understanding how we see order block in the IOF strategy, institutional order block strategy. We would look not deeply, just briefly on how to trade an order block. I assume if you've been following the institutional order flow, you should know how to trade the order block. We'll just look briefly at that. We'll look at liquidity points briefly and how to frame our risks while trading the order block. I don't intend that this webinar will be so long. So if for any reason we can't exhaust our objective for today, for this webinar as stated here, we might just pause halfway and continue sometime within the week, maybe Friday or Saturday after we're done with trading. Right, so I'll be starting with what an order block is. This definition was actually gotten from one of Michael's work. That I'll be using a bearish order block for a start. Is the highest candle or price bar with an up close that has the most range between the open and the close, and is near a resistance level. I added a supply zone. So basically, let's annotate a little here and see if we could frame out what we're trying to explain here. Right, so a bearish order block, the highest candle or price bar. You notice price is making an upward move, and price gets into a resistance or a support. The bearish order block, by this definition, and in extension by the way we look at order block in the institutional order flow, is the highest candle or price bar. Now, this is not taking into consideration the color of the candle as to whether it is bullish or bearish, right? You could have a bearish candle, however, with a very long wick. I'll still consider that as my order block, right? So the order block is actually, in this case, for a bearish order block, is actually the candle the highest point. For the sake of simplicity, let's just say the bullish candle with the highest close, right? But like I explained, there are times, depending on your broker and whatever feed they use, somebody is creating nuisance here. Just give me a minute. All right. So depending on your data feed, there are times that you could find it being a bearish candle with a very long wick up, right? So, and by this definition, it has to be coming into a resistance. So price coming into a resistance. The bullish candle in this case is the order block we're talking about, right? So it has to be very near a resistance level, or for those of us who trade supply and demand, at a supply zone. Right? We'll go to the chart later on and see examples of this. Of course, the reverse will be true for a bullish order block. the lowest candle or price bar, with a down close that has the most range. Now, you notice I underlined the two words there, most range. This issue came up a couple of times in the Telegram group. You could have an order block. The way we mark up order block is in an institutional order flow. And still we're going bearish order block. We'll say it is the last bullish candle, right, before a drop. Now, there are times you could have a bullish, you could have another order block. Let's say we have another order block in this box. We have the first order block in that box. Then we have another order block within this box again. What we'll do is that we'll use, since the second order box is within the range of the first order block, we just forget about the second one and use the first. We'll go to the chart again and you see examples. But if you're in the Telegram group, I'm sure you will remember we had this discussion very well. So when you have an intersect of order blocks as defined by the institutional order flow, we have the videos here on YouTube, and an order block is within the open and close, or even within the wicks, as the case may be, that is the high and the low of a preceding order block, then you forget about the new one and use the old order block because it has a higher range. So it's the range we are looking at, right? You can't have a smaller order block within a bigger one. You just use the bigger one as your major order block and forget about the smaller one, right? Because it's a block where orders were taken, and you want to be safe when framing out your trades, ensuring that your stop loss is not too tight as to be taken out when liquidity is being sought, right? Now, if we, in institutional order flow, we mark up the low candle before a push up as an OB, which I believe we understand. But if it is not near a support, it is a weak OB. And we should expect price to violate it easily, right? So let's go to the next slide. We'll come back here. Let's go to the next slide. So here is, I think, GU. This was GU, and we had this discussion 2 weeks ago or thereabout in the Telegram group. And you would notice clearly here that this was a bearish order flow. First, we had this taken out as our breaker, right? And price started dropping down. You notice we had, by our definition, this order block here. We were anticipating that when price trades into this block, then we would sell. Of course, price traded through it, but didn't close above it. So we were basically sellers. And then we sold down, right? We sold down. Then we had this order block here. We had the whole of this point being the new order block, which is the last bullish candle before this drop, right? And price was, we're expecting after this rejection that price was going to trade into the order block and drop. But if you're in the Telegram group, you notice I sent a markup and I was using this bullish candle here as a point I want price to break through before I consider this trade or the order flow to have become bullish. Why? Now we can see the two things I explained. Let's change the color here. You notice we have this as the last bullish candle before the drop, but we also have this candle here, which has a wider range. And the smaller candle is a subset, so to say, of the larger one. I would rather use the larger candle as my zone. I'd rather use the larger candle as my preferred zone or order block to sell this pair, right? I'll explain again. And of course, if you have questions after I'm done explaining, people ask. So the predominant trend was bearish. We have this as an order block. We have this as an order block. And of course, we have the whole of this wiki candle as an order block. But this was going to be our strong order block because it was leaving a resistance zone. Retail traders would take this as resistance, and support demand and supply traders will take the whole of this as a supply zone, right? So we're basically looking at, we'll still do this in the chart. I just need to clear this up. We'll go back and read the theory, then go back and see the chart, right? So I need us to get that we're looking at the candle with a wider range as our strong order block. And this candle here is basically a weak order block. Now we'll go back to the slide and see how we treat each of them, right? So back here, for IOF, we mark up the low candle before a push up as an OB. But if it is near a support level, we consider it a weak order block. And we should expect price to violate it easily, like we saw in GU, right? It is therefore not a level to anticipate high probability entries, but could be used as areas to cut wins in the case of a pullback. So say I'm anticipating price to drive into a weak order block and give me a fresh entry for a sell, like in the case of GU. If price violates that point, I might just want to get out of the trade, take whatever I have, then anticipate price trading back into the strong order block for me to have a re-entry. Why should I have made 40 pips and then wait for price to come all the way back to entry, right? I could use the weak order blocks as points where I could easily take off some profits if price seems to want to violate them, right? Then I have a re-entry. We had a similar issue with UJ just this week, where we're bullish on UJ. On Thursday, we're bullish on UJ. It went all the way into the Asian session buying. Then it became bearish from the Asian session back straight down to our entry. Then gave us a new one again, a new buy opportunity. If time permits, we'll see UJ, right? So it is therefore not a level to anticipate high probability entries, but could be used as areas to cut wins in the case of a pullback. And I've shown GU. Let's look at GJ. Let's see GJ on our chart. Right, so here we have GJ. Here we have GJ. By the definition we just gave now, you should be able to spot this as our strong order block and this as a weak order block, because this order block is leaving a resistance or a supply zone, right? So this is our strong order block. Of course, we like using the color red for that, right? This is our strong order block. You want to take your entries basically from the strong order block. That doesn't mean if an entry presents itself in a weak order block, you wouldn't pull the trigger. Remember, we had mentioned in earlier episodes that you frame your entry from the higher time frame, right? You have your bias from the higher time frame. However, in the intraday time frame from the 4 hours down, you should expect price to do a pullback, a retracement, and you'll be anticipating a trade setup when it comes into a major order block. There are times you could have, I do take trades from a weak order block, but with maybe half your lot size, you know, you do it with some form of caution, right? Because price may just override your position. So this was an order block. This was another order block based on our definition when using IOF, right? We'll be anticipating price to come into this order block, give us a reason to sell. We might have gotten an entry for a sell here, might have, right? But when price was trading back up, notice how seemingly easily it pierced through this order block, because this is a weak order block, right? It's just in the middle of nowhere. This is a strong order block because it is living from a resistance. Same thing happens if you have your order block living from a support. Then it becomes a strong order block. So you could frame up your own trade idea and say, one, I will never trade off an order block that is not a strong order block. What that does is that it gives you less trades, but high probability trades, right? You could frame it up that way. If you're one that always would love to always trade almost every day, then you could take up an entry at this order block for a sell if an opportunity presents itself. Best will be to wait for a strong order block, right? I think I stated it somewhere in the slide. Aside from leaving off a demand zone or a supply zone, as the case may be, another reason why we might say this is an order block is because if you drop down to the lower time frame, and we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days, 10 4-hour candles, about 40 hours of basic consolidation, right? This candle here that looks like a hammer or so would have taken out liquidity. So when price takes out liquidity and quickly runs away from that point, that is another definition of a strong order block, because price has picked out liquidity and is bailing away from that point. So here we have two ways we can look at a strong order block: as another block formed at a resistance or support level, and another block that occurs because price has taken out liquidity. So you want to have that at the back of your mind. Perhaps in the next time we meet, we would be looking at that. One very good way of trading the order blocks is the turtle soup pattern, where price would have taken out liquidity and quickly rally away from that point. Very good example of a strong order block. And most times when price comes back to either the fair value or the gap that has been created as a result of the quick movement of price away from that liquidity that has been grabbed, you have a re-entry for your trade, right? So let's move on. A strong order block will usually grab liquidity. I think we had mentioned that a strong order block will usually grab liquidity. It's not mandatory, but I think it should be mandatory that for it to be said to be strong, it should be coming off a resistance level. And usually the pattern of the market makers is that if they're within the point that is damned retail resistance or it's been consolidating for long, they usually will pick liquidity most times from both sides, giving us the M formation before they actually kick off in whatever direction they want to make. So we should be careful to mark our charts from the left to the right. I see so many people coming into a chart for the very first time, and you're just marking up this point. Sorry, let me take out all of this. And they seem to just mark up this area as a source or breaker or whatever. You have to remember that price flows from the left to the right, right? So let's have an example. If we were to mark up this chart and we were just coming in when this was happening, right? So everything to the right of this line hasn't happened yet. What I expect us to do is to actually look at the right. So our markup will actually start from this high point as our source, right? Notice that it is actually a bearish candle, but that is our source. That's the highest candle. And by the definition of an order block, you also want to see that as a, let's go back to the definition, right? The highest candle or price bar, irrespective of the color, right? Then we'll have this bearish candle, let's make this, right? So we have this as our block. We could now take this point with the wick down, remember we always consider the wick of the candle to the right as our breaker. Price broke through here on this candle, retested both the source and the order block and the breaker, and then dropped off from there, right? Price came back to test this strong order block. So actually the move here was a retest of the strong order block. And most times when you have a retest of the strong order block, it usually comes with some massive price movements, right? So that's something new we're trying to explain here, that if you have an intersect of two order blocks based on how we had defined order block prior to this webinar, you should consider the order block with a wider range. Then when marking up your source, like I just did here, let's use the right delineation here. This would usually be blue. You should consider the candle with the highest wick, the price bar with the highest wick, irrespective of the color, right? So let's move on. So when trading a breaker on H4 that is against the higher time frame order flow, you should be conservative with your target objectives, and we'll explain more of that in the next slide. So we're done with this, right? So an order block, if you remember the first definition, is actually let's go back here, magnify this a little. The order block is this candle. The candle itself is the order block, right? So what validates it as a bearish order block or a bullish order block, as the case may be? So subsequent candle closes above for a bullish order block and below for a bearish order block. That is when the order block is validated, right? So when price closes beneath it, usually we expect it to be very, very fast. In this case, it wasn't, but there was a price close beneath it, now indicating willingness for price to come down. Then we say we have an order block, right? That is when it's basically validated. Now, the vigor with which price leaves the area is another factor that determines whether the order block is strong or weak, and it gives a good trade entry when price returns to fair value. We should discuss that later on. Now, where an order block is formed after price takes out liquidity, we most usually will have a turtle soup formation, which is one of the safest trade setups using the order block theory, right? So let's see if we can have examples of this in the chart. Let's see, let's go to GU. I marked up some things here. Let's quickly go through that first before going back into GU. Okay, I think I've explained this area. Okay, I did that on GJ. Notice how price traded through this weak order block and came straight into this strong order block, right? And on a higher time frame, we're clearly in a bearish trend. And so when I said, when you are trading the H4 breaker against the higher time frame order flow, you should be conservative with your target objectives, right? So say we're going long, say we had a reason to go long here after price broke this order block and gave us what seemed to be a breaker on the 4 hours. We have to remember that the higher time frame is bearish, and our trade objective in terms of targets, TPs, should be conservative, because we're basically trading against the higher time frame order flow, right? So what I see most people do, or some people do rather, in the Telegram group, is that price traded above this and we simply say we are in a bullish order flow. No, we are not in a bullish order flow. I will say I'm in a bullish order flow perhaps if price pierces through and breaks this strong order block here. Then I might say we are in a bullish order flow. I assume that the way the price candles will print at the close of business might give us a bullish order block if price trades through this we might have a bullish order block formation, perhaps on the daily, that will now support the idea that we are now bullish, right? But this is just a pullback. So price gave us a breaker somewhere around here, trading above this bearish order block. This became a breaker. What I see some people do is that they'll be anticipating a retest of this for a push up. With this added information, you should know that what you're trading into is a strong bearish order block, and should you actually be anticipating a rejection of the strong order block, coupled with the fact that on the higher time frame we are actually bearish, right? So we need to have those things at the back of our mind as we look at price action. Now, where the order block is formed after price takes out liquidity, we usually would have a turtle soup formation. Yes, I think we're trying to do that before I deviated. Yeah, let's see this. Let's see this scenario here, right? So price basically took out this liquidity here. Price basically just took out liquidity and rallied away, right? That was exactly what price did. Took out liquidity, pushed up, right? Say you want to be someone who trades sparingly just once a while, then there is a setup here. The setup is that, of course, we would pick this area as our order block first and foremost, right? Because the candle beneath, assuming we can't see everything to the left of the screen. So let's assume we can't see everything to the left of the screen, and we're just starting from this green box. We would assume that this is the lowest point, right? Now, aside that, the setup I'm trying to explain is that when you see price trading away from a zone that has been considered perhaps a resistance or a support, and price has taken liquidity before that rally, a good trade setup will be to spot out a fair value gap, a liquidity void, or whatsoever very close to the peak of your takeoff, right? So in this case, we had something here, right? We had this gap here. We had this gap here. And oftentimes, when this happens and price returns back to this zone, you should expect an explosive rejection. So if we place two horizontal lines here, we could check to see if price actually returned to that point and what price did after it returned to it, right? How price became explosive upon returning to this point. And I think we mentioned something similar there. Move on, I think somewhere within the slide. So, right, so the entry techniques in trading and OB is that price returns to the order block, which is one, or price returns to a fair value caused by the order block, right? Especially where you have a turtle soup type of formation. And that is the entry technique for trading an order block. So you have, when you have an order block formed, let's take this as an example. Say we've marked up this point here as our order block. I will have that as blue, order block. We would usually mark up this area as our breaker because price broke through it and thereby broke market structure, right? We'll have this area as our breaker. You would have heard me several times say, I prefer when the breaker and the order block are close, or in fact have some form of intersect. It makes me a little bit more comfortable to take that trade. And the reason is simply because when you have an order block, you want price to do a retest of that order block. If for any reason price rallies away from a source, right, which we call an order block, is actually a source. It's actually an order block. We just nickname it source, right? It's actually an order block. If price rallies away from this order block, without actually giving us a retest. What that retest does is that it closes the fair value, it closes, everything. It's like price will have no draw to come back to that area so soon. After it has retested it, it leaves, and you can confidently, you can almost confidently take that trade with some level of assurance that price may not come back too soon, right? So, but if you have it separated like we have here, and you take your trade, I think the last webinar we had, I gave us how we should go in if price doesn't test the source, right? I said we should wait for the fifth wave, right? A trade low and a retest, which actually happened somewhere here for us to take the trade, right? Because when price was inching up here, we would actually be anticipating a retest of the source. Now, when price didn't give us a retest, we simply leave this markup on our chart because it has given us an untested order block. An untested order block. And when we have an untested order block, we have a sweet setup in our hands. Sweet setup for two reasons. One, when the setup when the trade presents itself, the stop loss will be very, very, very small, right? The risk will be small compared to the take profits or the available profits that we might be able to take from the market. So see this situation. This is the source, right? Price never came back to test the source. We simply just keep this source. And if you're like me, you just simply put an alert trading and go to alert, trigger an alert. You can see that right here on my screen, right? That arrow there. You could basically trigger an alert. You could basically trigger an alert to alert you when price returns back to this zone, and you should be expecting an explosive move off that point. Why? Because this order block we call a source hasn't been retested. What simply happened here is that let's magnify this a little more. What simply happened here is that we had a fair value gap or void or whatever name you want to call it here, and price needed to come to fill that up. And when price does that, which it did here, you notice the explosive move away. The same example I gave here, the same example I gave earlier on here, right? So let's take these lines off. Let's take these lines off. And like I said, let's assume let's assume everything to the left of the screen we can't actually see it. And we're just considering this point as our order block being the lowest, right, into liquidity, having taken out liquidity, right? Now notice that we have a gap, just like I explained. And if we mark this up as our source, and this point as our breaker, just for the purpose of illustration, right? You would notice that we had the retest of the breaker, but not the retest of the source. Even though I said I wouldn't be confident to take this trade because I will be anticipating price to trade back to fill up this void or gap, as that will mean to me a retest of the source for our rally. But price never came here. So taking the trade off here at first might be with half the lot size. Of course, we'll have our LSB or break market structure to have initiated the longs from this point, right? We would have that. Basically, what we just had is a high, a low, a high, a higher high, a lower low. Then we had price breaking through. Price broke through here, giving us you know, a higher high, and then we had a low. So this was actually a break in market structure, right? Maybe I should do this. So we initially had this, something like that. We had this, then we had this, right? This push up closed above this high, right? That is why we call this a breaker. Price, we should expect price to trade back into this breaker zone for a push up. Now, what I'm saying is, I'm usually not comfortable trading this setup because you don't know when it's going to fail. Price could as well just trade back down into your source. And if you had framed up your entry on the 4 hours, now you have a wide SL to play with. And you know we like taking our trades from 15 minutes. And recently, following Michael has been even teaching how to take your trades on 5 minutes, right? So I would rather prefer price to trade back into my source. So would usually have marked this up as our breaker, then marked this up as our source. I would want price to trade and test both the breaker and the source. If price for any reason tests just the breaker and then rallies from there, I would be anticipating, I'll be more comfortable to take a trade when price returns back to this zone and gives me another reason to go long. Now my point of interest will be this zone here. That doesn't mean that I don't trade off the breaker. If I get my setup on the 15 minutes, especially if there are liquidity, like if we have wicks to the downside that could serve as retail support, and price pierces through it, takes it out and gives me a reason to go long, I'll go long. But I'm more comfortable if price comes back to test my source. If price doesn't test my source, I simply keep that source till a later date and anticipate price coming back to fill an objective that would have been framed up already. Here we have that gap, like I just explained, right? We have this gap here. We'll be anticipating price to come to fill up that for an explosive rally, right? Why? Because we had something that looks like an untested source, right? So here we have three things coming into play. We're having a turtle soup-like formation. We're having an untested source, right? And we're having a new type of way to take our trades, which I just explained. I don't think I've explained this in any of the webinars before. So when you have an untested source, other source, yes, we might have missed some tips in the sense that we are not too comfortable to take the trade off the breaker. But we're a bit happy because we would be going back into that untested source to look for price trading back into fair value, right? Then we take our trade. This time the trade is even sweeter because your objective now will be the previous swing low, right? So if I missed out on this trade here, right? My objective when price traded back into this area will be the next high, right? And my objective when price traded into this zone, seeing that I had an untested source, will be the next low. So it gives me, and that is why you notice in SimplyPips, we've been saying we basically trade from source to source. We basically trade from source to source. We'll be repeating that. And the reason why we'll be repeating that is simply because, I'm jumping slides, I'm going to come back. It's simply because I can't remember where I heard this, but I've heard it, and in my few time of trading, I discovered that it's actually true. That price consolidates more frequently than it trends. That is what I meant to say, not that the consolidation and range are the same. Price basically consolidates more frequently than it trends, right? even when we say price is trending, like on the 4 hours, we say price is trending. But what price has been doing on GU basically, as you can see, is consolidating. It's basically been going up, down, up, down. It's actually consolidating. Even though we say on the 4 hours, we could mark up this zone like this and say price is trending. In fact, trend line traders could just mark this up as a trend and say price is trending upwards. But looking at it holistically, what price has been doing is basically ranging. So price spends majority of its time in a range on all time frames than actually trending. So that is why we say we trade most times from source to source, because in the recent, that is where we actually catch most of our trades. We could take both the buys and the sell and the buys and the sell, as against when it is trending heavily down this way, and we usually will not take our buy because the order flow is simply bearish. Right, so let's go back to our slide. So the entry technique is for price, is that when price returns to the order block or a fair value caused by the order block, now we are ready to pull our trigger. So say we have an order block. And I need you to remember that we had said earlier that a source is actually an order block. We are just saying that the source is the beginning of the change in trend. That is why we call it the source. But it's actually an order block. The breaker itself is also an order block, but maybe a weak order block, right? The source is an order block. Notice this area here, giving us something similar to what I explained earlier, trading into some gaps here, right? Price trading into some gaps here and then dropping thereafter. So when price returns to an order block of fair value, that was what I was trying to explain. Let's see an example. Maybe we should go to UJ, see if we can find an example there. Let's go to EU, Euro USD, and go back to daily time frame. Let's go back to the daily time frame. Let's consider this here and say this is our daily order block, for instance. When price begins to trade back into this order block, that is when we look for opportunities to go to take price in the opposite direction. And I think we've explained that in the previous videos. That's the meaning of this entry technique: price returning to the order block of fair value, right? Now, the close of the order block is usually where we would have our stop loss if we're trading off the 4 hours. If you're trading off the 4 hours, the close of your order block should be where you have your stop loss. If the order block is going to hold, then price shouldn't come back into it. So let's look for a good example to use here. Right, in this case, we'll be having this as our order block. Now remember somebody asking that why didn't we use this candle as the breaker? I wasn't comfortable because there was a gap there, and I usually don't want to mark up gaps, right? So, and that's why I use this. But whichever candle you use still works. If it works fine for you, you could as well have used this as the breaker, right? So if price trades back into the order block, then I'm looking for reasons to want to sell. I'm looking for something very simple. Okay, so let's use this. So say this is our order block, right? When price is trading back into this order block, then I begin to anticipate reasons to want to sell off this zone. My stop loss then should be behind the order block, right? And if price progresses away from the order block, like 1-2 candles away from the order block, I should be confident enough to bring my stop loss even closer right? So Michael says like 50% into the order block, right? If I want to reduce my risk, right? If I feel I need to reduce my risk, if price trades away, I might be able to bring my stop loss into 50%. And that's what I tried to capture here, even though it looks like the way I framed it up doesn't make so much sense. Right, so during price consolidation, price consolidates more frequently than it trends. During consolidation, it is wise to pair your trade to a nearby liquidity point, basically from source to source, while anticipating earlier liquidity points as possible areas to scale off profits. Now, so let's go back to what pair was that? GU or GJ? I guess it was GU. Right, so now what I mean there is if I was going long here and I should be taking out this area here as my first point of taking my profit, right? That's the meaning of the sentence, the statement. Basically, so while anticipating earlier liquidity points as possible areas to scale off profit. Now, I might not close the whole trade, but I should consider this area here, right? That would usually serve as retail resistance as a place where I expect price, where I want to scale off some of my profit. Now, if you've traded price action long enough, sorry, let's make this thing neater. If you traded price action long enough, you would know that this concept of taking out liquidity and then moving in the opposite direction for a while and all that happens on every time frame, right? On every time frame. So if this point here serves as retail support, you should expect that price should, retail resistance, I beg your pardon, you should expect that price should take out liquidity and run away for a while, and not just run away, also take out liquidity in the lower region. So taking out liquidity here, basically, sorry, what I mean is taking out liquidity around this point and also coming to a short time, liquidity pool again and take out liquidity there, then it continues its move up, right? So if I were buying, I should be considering this area here as a possible place to take out, scale off my profit. One, it serves as retail support and resistance. In fact, most retail traders will see this area here as a flip zone or a turnkey support or resistance, as the case may be, right? So price came there, served as resistance before, broke through it, served as support before breaking through it again. So this will be seen as a strong zone for retail traders. You want price to, kind of take out liquidity there, drop down, take out liquidity and move on. But if you scaled off some of your profits at this point, you should be confident enough to perhaps hold on to your trade if you understand that this is an untested source and that price might want to, move towards that area. Now, liquidity points, we wouldn't spend so much time on this. I think we've discussed them before, and we all know them. Yesterday high, yesterday low, weekly low and weekly highs, monthly highs and monthly lows. Of course, we have the double and triple tops and the bottoms, clean highs, and equal highs or clean highs. All these points are liquidity points, and you see them even better on the lower time frame, something like the 15 minutes, right? You see them very, very well on things like 15 minutes. You want to see clean highs taken out. For those of us who trade the Steve Monroe's method, he talks about the M and the W, and the M and the W is basically price taking out liquidity at those points. So let's say one of the London trade formation is that price comes, takes out liquidity or gives what he calls a vector move, comes down and trades a little and drop from this webinar now, we'll say the one we love the most is when it does something like this and drops down. We will be so we have the first trade after the shift if you trade Steve Moreau, but you should also know that after dropping, after leaving that region in a very fast way, and since this is turtle soup, we will be anticipating a retest of whatever fair value has been created here for a continuation of our trade, right? Those are ways we could trade them. So I'm not here to say don't use indicators or the like. Use whatever works best for you. With time, you might be able to work without using indicators, but you should know that I think we have a template here, right? We should know that there's an indicator called the yesterday high and yesterday low. And one way we frame our entries, if you know the 4 rules we look out for before taking a trade using the IOF, is first one is identify the order flow on the H4. And the reason why we are looking at the H4 is simply because we just want to trade every day, intraday traders, right? And we've said severally that doesn't mean you should forget about the order flow on the higher time frame. Now, if we are bullish, we like to see the deep retracements. We love to see the deep retracement. That takes us to UJ here, right? Let's quickly do this before going back. We love to see the deep retracement. And that was exactly what happened with UJ. We were bullish of UJ. This was our order block. And I'm assuming that by now, we all know that this was a weak order block. It was basically in the middle of nowhere, right? So even though we're anticipating a buy from this point, we should have at the back of our mind that price could easily fall off and continue its downwards move, right? It was basically a weak order block. Now, besides being a weak order block, I want us to notice some other things that are happening here, right? When price came down here, I remember some of us took this trade, we were stopped out, and we came back. This was the UJ I mentioned when I was saying when you're going long, sorry, I seem to be saying so many things at the same time. I'll put myself together very soon, right? So I'll leave the initial illustration and come back to this trade I told you we took this week. Some of us were stopped out here, right? I remember, I think I can spot 2 or 3 people in this webinar. They were stopped out here at first. Then we had this reason to go long. I was actually anticipating that price would come to this area, right? I was anticipating that price would come to this area. And that was simply because we were bullish on DXY. And I was anticipating that DXY will take out the liquidity basically here. There are some liquidity points here. I was anticipating DXY will take that out. Then we might begin to study price action to know if DXY will want to come to fill whatever fair value is up here after piercing through. Then maybe we might begin to anticipate a downside for the DXY, right? So we're basically bullish the USD, right? So we went long from this point. Now, what did I say about taking out? This looks to me like a clean high somehow, right? So if we were going long off the 4 hours as intraday traders, little as these pips may be, small as we may think it is, this would be a good place to scale off your profits, right? Because price might just want to come back, pick out liquidity again. And I think I mentioned that somewhere in the slide. So we had 3 TPs, TP1 here, TP2 at this order block, this bearish order block. The tip of this bearish order block here was at TP2, and we were actually anticipating price to take out this high if the bullish order flow was going to be respected, right? Price traded, hit our TP1 and 2 and fell off. Now, if we had not scaled out some profits by having TP1 and 2, right, there is that tendency that we might begin to anticipate that price will make a U-turn somewhere in between until price came back to our entry, then gave us a new reason to go long again, right? It gave us a new reason to go long. So we went long, and I don't know, I went out. Some of my team members might still be in UJ long. So let's go back to this analogy we're trying to give here. This was a weak OB. Price was trading into the weak OB. We should anticipate from the order block, institutional order flow theory, we should be anticipating a buy from here. Now, but with the new knowledge of the fact that this is a weak order block, we should also anticipate that price will pierce through and perhaps even drop, right? Now, so what do we do now? We actually want to wait rather than put our sell limit. We actually want to wait to see what price will do at that weak order block. And whatever price does there might give us a reason to frame a buy entry, right? If you understand the gaps also, what price really came here to do was just fill up this gap. There was a gap between this bullish candle and this bearish candle. And price simply came there, fill up that gap to the peep, and then rallied and never came back. And never came back, right? So that was what price actually came to do. Now, yesterday high, yesterday low, weekly high, I think we just came through this. If there's the way you can mark them up, either using indicators or whatever, be free. At the end of the day, getting pips out of the market is what happens, is what matters the most. When you have clean highs, equal highs, or even Asian range, the high of the Asian range, right? Those are areas where you should also spot. The high of the Asian range are areas where you expect liquidity to be seated. And many times you see price trading above the Asian range high and then dropping. Many a times you see that. And you see it like in this case, price traded beneath the Asian range low, which also coincided with yesterday's low and gave us what looks like a turtle soup formation for, for a long trade, right? So let's go down to the final part. Entry dynamics, and we'll just explain a little. We've done about 59 minutes. Shouldn't be more than an hour or so. So we might discuss entry dynamics much more better in subsequent webinar, but for the purpose of this one, let's just read it through. So if you are in a bullish institutional order flow, bullish on the higher time frame, and by higher time frame I actually mean the monthly, the weekly, or the daily, when price in H4 or other intraday time frame is pulling back towards the order block of the higher time frame, and remember we started in a bullish higher time frame order flow, you should anticipate a long trade. So what I see most times is that we concentrate so much on the 4 hours as intraday traders, and even though the 4 hours seem to be giving us that we are in a bullish, let's go to GU. So let's say, even though the 4 hours is giving us an indication that we are bullish because we've had a breaker here, we shouldn't forget that on the higher time frame, we are actually bearish. We shouldn't forget that. I think same thing happened with EU, right? EU has been a perpetual bearish trend from, like, I can't remember when, right? If we pull this in, GU has been bearish from, which date is this? 2017, right? It's basically been bearish. If you had just used a 0.1 lot size from 2017 and leave it like that on a sell, irrespective of all the months and weeks where we had pullbacks, it's been a bearish downtrend. It's been bearish, basically, right? So if you have on the H4 a time where GU seems to be giving you an insinuation that you are bullish, you shouldn't forget the fact that the higher time frame is still bearish. You should mark up your order blocks on the higher time frame, and even if you trade the counter trend, you should anticipate a rejection of the bearish order block of the higher time frame. You should anticipate that, right? That is how we frame up our entry dynamics. So if we are bullish on a monthly, weekly, or daily, when price on the H4 or intraday time frame, which means anything lower than H4, is pulling back towards the order block of the higher time frame, you should anticipate a long trade. Most successful trade setups occur when price enters a discount level. We would discuss discount level later on, but you could watch some of Michael's wonderful videos on YouTube. He does a very good job of explaining discount beyond what I can ever explain. So you should then watch out for raids on sell side liquidities in the form of protected stops, return to bullish order blocks, filling of fair value gaps or liquidity voids, and the likes, right? For your continuation trade. So if price has traded from the 4-hour into your order block on the higher time frame, you should be able to spot out, fair values, liquidity voids, or where you think the retail traders will have their protected stop. And we just explained that in the previous point: yesterday high, yesterday low, weekly high, and all of those points. At those points, you should be expecting price to take out liquidity there and then reject. So your target should traditionally be a recent high, or actually meant, a recent high, to keep in line with the bullishness of the order flow, right? So let's say, on the higher time frame, we have our order block marked up here. Say this zone here is our order block on a higher time frame. Weekly, monthly, daily, right? And in case your MT4 also has a yearly candle, you could add yearly to that illustration, right? So on the lower time frame, which is the 4 hours, we had a breaker and we were actually bullish. We traded after the breaker was formed from point B. We're trading bullish, right? We shouldn't forget that we have a higher time frame bearish order block. When price trades into it, we should be looking for fair value gaps, liquidity voids, clean highs. Yesterday, in fact, most times what price will do, well, I shouldn't say most time, not a market maker, but what I've observed that price will do many a times is that when it gets into that zone, if it hits, like I explained in this webinar, where if you had marked it up as your source, it could do an explosive move to the downside. And if it is not an explosive move, price will consolidate for some time, do occasional spike up, spike down, right? And accumulate for a while. And most times, before it makes its final move, it will take out yesterday's high and then drop, right? We had something that looks similar to this, not exactly the same, similar to this on EU. So let's look at EU on the 15 minutes, right? So in SimplyPips, we took an EU sell. While some people were bullish, we were anticipating EU to take out this high. And when EU took this high, we were bearish. We were basically bearish from this point, right? And that was exactly what I just explained. So for the alternate is true for a bearish order flow. We'll discuss more next webinar. I would like to give room for questions. If you have questions, let's discuss them. Can you give an example of a breaker? How many candles should be in a breaker? It's not as, it is more about market structure than it is about the number of candles, right? It's more about market structure. So let's say we were, okay, let's take this illustration we're on. what we would be anticipating, so let's take out this other block so we don't mix up things. Price was bullish. We would be anticipating that price creates a lower low and continue the move. But rather than price creating a lower low, sorry, a higher low to continue to move, price broke down. If it took 20 candles to break below A, right, we simply will just pick the last candle with the new definition now, the last candle with the wider range, right? The last bullish candle with the wider range, or rather the bearish candle with the wider range that was broken to be our breaker. So our breaker will be somewhere here. We would now be anticipating two types of trade setups, right? Two types of trade setups will come up here. The first one is that, so we had this, price broke down. First is that we should be, and let me clear up this, sorry guys, sorry, make it, I will want both to be on the same screen, so we see them, right? Just give me a minute, please. Okay, so what I'll be anticipating is that we're in a bullish trend, and I have a break in market structure, right? Instead of a lower, higher low, we now have a lower low. I've been anticipating a retest of our breaker for a drop, right? Now, second one, this guy here has two variations. This is the normal variation, the one you and I trade most time using institutional order flow, and the one we love the most is that we usually will not want the distance between this and this to be more than 20 pips or at most 50 pips for a GBP related pair, because that will now fit into a turtle soup formation, right? Now, but let's leave that for another webinar. The one we say we love trading using institutional order flow is where we have something like this, break in market structure, retests not at this level, but beyond this level, such that it tests both the source and the breaker simultaneously. Most times when this happens, there will be no objective for price to come back to. The void, the gaps, and blah, blah, blah has been taken, and price will usually rally for a longer period of time in the opposite direction. So it is not, it's not about the number of candles. Let's see if we can find an example somewhere here. So we're on the 4 hours, and this is Euro USD. Okay, so let's come to this example here. Or even, let's take this one. This one looks more clumsy. I might just explain several things together. So price was making lower lows. Price came into this point, pushed up, and came back and gave us even a lower low, right? So we usually would use the last bearish candle before the low that was created as our breaker. If you don't understand it, please go watch. We have a 5-part series on this channel. This will be the order block responsible for this low, right? The lowest point here, coincidentally, happens to be this. We would usually mark this up as our source and have this be our breaker, right? Not minding any mistake in the markup now. So price traded above the breaker, the order block, and that's why it became a breaker. Price came back, retested the source and the order block, albeit so little, but retest and then rally. So it is not a matter of the number of candles, but that market structure was broken by this bullish engulfing candle, right? Now, trade objective for normal order block, let's take out this and let's consider this bullish and bearish candle. So considering the bullish and bearish candle alone, we will take this zone here as an order block. If we forget about everything to the left, and we're taking just this bullish engulfing candle. Framing up an entry will be when price trades back into this order block. Remember, the order block is actually the bearish candle. The bullish candle simply just authenticated, validated the order block, right? So when price trades back into this, we usually would not expect price to go below the order block, and that's why we put our SL there, right? So I think I'm done with that before I mix things up. Yes, and if an order block is created inside the source and breaker zone, then it gives you additional bonus confirmation. Exactly. And if another block is created inside the source and breaker zone, it gives you additional bonus confirmation. That is another information I didn't want to bring out now, but maybe at the next webinar we'll discuss that, Darren. Yeah, so if an order block is created inside the source and the breaker zone, you have additional bonus confirmation to pull your trigger, right? But we shouldn't give out everything just one day. It's in bits and pieces, right? So do we anticipate continuous move at a strong OB or a weak OB? We anticipate continuous move when price reaches a strong OB, you anticipate a rejection, right? If the OB is bullish and price is retracing back into the OB as a sell, you should anticipate a continuation of the bullish trend from the strong OB. However, we have seen that we could also have entries of weak OBs. We've seen that in time past, right? If you remember, again, let's leave out everything here. Let's say we forget about everything here, everything from that rectangle to the left. So we don't do a lot of explanation. We run out of time already. So magnify this a little more. This is the bearish candle here, and we usually would delineate it with red. So that is the bearish candle. Even though it looks like a doji, we might use it for this. Bearish candle responsible for this high. We'll be anticipating that when price trades into it, it should go up, right? And it created a new high here. It created a new high with that doji of a candle, right? Then it gave us a new bearish candle responsible for this push-up. Price traded back again into it. You can see the touch. Price traded back into it and gave us a high. This was the next candle responsible for this high, right? Price didn't come back to it. And that's how we keep marking up. Now, somewhere in between here, you have a weak order block. If price is trading back in the form of a sell into this order block, we will be anticipating an entry here by LSB on M15 for a buy. However, we would also have at the back of our mind that because it's a weak OB, price could just pierce through it and go to test the strong order block there. In fact, it might not be a full candle, it might just be a weak, right? So you could just see something like this with a very long wick. It happens many times, right? And that is why, even though many of us pride in the fact that we don't use indicators, I tell newbies to always try to patch it up while you're still learning. If you use your indicator off the 15 minutes, at that point where you have a pierce through to the strong order block, you would have a sharp fin or divergence. And that will give you your entry after LSB. And if price doesn't pierce through, but price actually traded through to the strong order block, you would most times, not all of the time, but you most times not find an LSB for you to go into that trade. And if you do, it simply hits your stop loss of 20, 30 pips and you're out of that trade. It's as simple as that, right? So what the guys in the Modify IOF, of course, you know, we've gone much more deeper and further than this. In the next section, I may be able to provide additional illustration on how to use the FIPS to add as an additional confirmation level, which is what I do, and I've backtested a specific way to place the FIPS in this situation. And it's almost OTE every time if you do it right. Yes, so Darren Flynn has just publicly booked a webinar for us. I'll be talking with him later on to see how to do that. And of course, somebody, I think it was Jason in the group, told us of the philanthropic work that Michael is doing now, a 20-day series OTE entry. We could also discuss that. So let's put a 555 and five fingers to clap and appreciate Darren for that offer, right? So yes, we have to call it a wrap here tonight. Thank you all for coming. The truth is this: if we put in enough work, we would become what we desire and what we are working towards. Yeah, so we have one of the admins of SimplyPips, the prof here himself. We appreciate you for coming online. So guys, I think we've done enough for today. Let's not drag this much longer so it becomes easier to watch on YouTube. We'll be back again perhaps on Saturday when we're done with dealing with the markets this week, and we might just have another webinar. Nice having you guys online. Have a we don't have enough time to do a market preview. We don't have. It's already past 10. So see you guys.